everybody, it's Benny and I'm back again. So I'm going through like a lot of stuff this week, for next week rather, and I come across some things I got from my research, and I said, oh wow, why don't I share it with you guys? Um, Before we go into the nitty-gritty of today's lesson, um, sometimes in our bid to become financially independent, we have to take certain steps. We might have to do some things we're not used to, and I noticed that in what discourages a lot of people is the jargon, right? So when you're listening to maybe guys on Wall Street or investment gurus, they use a lot of jargon, and it kind of how will I put it? It confuses people and discourages people. I used to be very intimidated, so I started to do research to break down certain things so they don't look so alien. And most of these things are doable. It's just that people like to present them in a very complex manner that might discourage the next person more often than not. When you see people still go after a business idea that sounds so complex, most times because they want to challenge themselves, but more often than not, it confuses people. So I do my best to present the message in a very simplified manner so people like you and I can understand. So today I'm going to talk about something a little bit off my niche, and something I know many young people have not explored that is possible. I want to talk about hedge funds, right? Hedge funds. So hedge funds are alternative investment models designed to secure investment portfolios from market uncertainty while generating positive returns. So the hedge fund model is created in a secure manner. So it's not just a company or an investor or an investment company coming to take your capital and say, okay, no, invest here, we'll manage it and you get the returns on investment in like 1 year. No. Hedge fund usually makes use of a more aggressive style, and then the hedge fund model also makes it possible for the portfolio manager to invest in more kinds of investments. Let me explain this further now. Most times, most stockbrokers just take money and put them in stocks and certain defined markets. But with a hedge fund, the portfolio manager and the investment banker is allowed to go into more aggressive kinds of investments and even go out of the niche. The funds are made to go into different kinds of investment. A hedge fund model usually makes use of pooled funds. So they take funds from different investors, right? They take funds from here. You can have up to 50 investors in one hedge fund, right? And they are usually established as limited liability companies or limited partnerships. That brings me to why it's designed that way. It's a high risk, but also a very highly profitable means of investment. So they are usually established as a limited liability company platform to minimize risk and to disassociate the individual from possible loss, and to also protect the funds from market uncertainty. So as an LLC, there's every chance that even if losses occur, the investor is not held accountable for it. So it's a secure means, though risky. Let me give you an example now. Some people do real estate hedge funds, so they take money from a group of people with capital, and they pull it together and buy like multiple units and upgrade those units and resell those units, right? And they give the return on investment back to the investors and also take their percentage. That's the hedge fund managers now, who are usually the investment managers or portfolio managers, depending on how you use the terms interchangeably. So they are usually within a time frame. So I'll tell all, for instance, I want to start a hedge fund. I tell everybody, all the people bringing capital, all the investors. So I'm going to manage the portfolio for 1 year. After 1 year, everybody gets a return on investment, and the hedge fund is dissolved. right? So it usually has a time frame, sometimes 1 year, sometimes 2 years, sometimes 5 years. The most common hedge funds are real estate. It can be real estate, it can be stock market hedge funds, it can be different kinds of hedge funds, just for buying businesses, for buying and selling businesses, Uh, Usually the time frame is referred to as a lockup period, so no access to the funds until the end of the tenure of the hedge fund. And hedge fund managers usually charge a fee. So what's common in this part of the world is, as an investment manager or portfolio manager or hedge fund manager, I pull funds together from a bunch of people called investors, and I charge them. Usually it's a 2% fee on the total amount of money paid to the fund. You take the 2%, and then also usually the agreements come with a 20% of the return of investment also towards the hedge fund manager. So you see, for all the active work and all the investment, managing the investment, making sure nothing goes wrong, making sure that you yield the highest returns on that investment within the agreed time frame. You get to keep 20% of the total returns on investment, the total profit on the investment, and the remaining 80% goes to the investor. So 20% is the usual thing, but in some cases, let's say in highly profitable settings, you might find hedge fund managers trying to negotiate upwards, right? And usually the perfect hedge fund is made up of the expert investor. So one person or two people who are very good at studying the markets, doing the feasibility reports, and knowing what direction the fund should go to. And then there's the fund manager. Who is the fund manager? The person who controls the money, who controls the cash flow or the asset flow, right? And then there's the money raiser. So if you decide to start your hedge fund today, you need someone who is aggressive in raising money. There's some people that are gifted, like they walk into a room and they can get everybody to sign a check. So yes, so that's the perfect hedge fund team. I'm going to just put it up here so we can take a look at it up close. So the perfect hedge fund team, as I said, the first person has to be the expert investor, right? And the second person has to be the fund manager, the person who controls the cash flow or asset flow. And then the third person has to be the aggressive money raiser. So these three people make the perfect hedge fund investment team. Now, many people are made to believe that starting a hedge fund is out of reach, but it's not out of reach. It's a very simple, though very high risk model. It's simple and it's something you can manage. You don't need a Harvard degree. You don't need to go to London School of Business to understand what hedge funds mean. You can actually learn how to start your own fund and also dissolve your fund. Now, I'm going to give you one last piece of information that will help you also if you decide to look in this direction, because I know many young people don't really like to go into hedge funding, and it seems a bit intimidating to some people, but really it's possible and it's doable and it's achievable. So the first kind of hedge fund, there are two models I'll tell you about. The first one I'm going to inform you about is the fund model. Usually this is the simple, I'm going to put simple in bracket, right? It's simple, so or I'll call it the linear fund model. Everything works in a straight line. Investors bring money, right? Investors invest money. Fund managers control investment, then leading to returns on investment and the solution, right? The simple linear fund model really is straightforward. People bring money together, they pull funds together, they pull capital together, and they invest it in either one type of investment or just one thing. And at the end of the term, usually a year, 2 years, 5 years, the returns are being divided. The hedge fund managers get to keep their 20% as agreed, and everybody walks, right? But then there's the loop model, or will I say the circular model. I don't advise beginners to go for this model, but this model also pays in the sense that even if there's an agreed time frame, say you put together a hedge fund for 5 years and you have a total of 10 investors on that hedge fund who you're managing the portfolio on behalf of, you get to pay in the loop model. You don't just invest in one thing, you invest in multiple sources of income, and you get to also pay returns on investment as opposed to a one-time payment of returns on investment. You get to pay either maybe quarterly or every 6 months or every 1 year annually. Also, the loop model gives the hedge fund manager the right to, after closing a deal with the capital, a right to reinvest and keep reinvesting until the expiration of the time frame of the hedge fund. So instead of the linear process, right, which is absolute, under the loop model, instead of dissolution, after returns on investment, the capital is taken back again, and the cycle begins again. This process continues up until the expiration of the hedge fund. Usually, when hedge funds are started with a long time frame, they're usually a loop model, because most times they just keep reinvesting and reinvesting and reinvesting. In some cases, they don't even, the investors will say, oh, okay, my returns, how about we put my returns back into the fund, right? So increasing the capital, amount of capital for the hedge fund managers to reinvest. That option is also there. So this is just my little bits or my nuggets about hedge funding. It's something you can go into. It's very easy to set up. What you need also is to have a legal team to draw up the paperwork for you, to make sure that every clause is being understood also by the investors. Once you have your legalities in place and you have your capital in place, it makes it easier for you to invest. Another way to make it easy, instead of saying, oh, trying to press a bunch of people to get you to write a check for you to invest, you can also instead find the amazing deal. Find deals that are so amazing. Especially with real estate hedge funds, these hedge funds tend to move faster, better, because the returns of investments or the business model for real estate is pretty much easy to understand. So if you get a good deal, you get maybe some acres of land, and you can see the potential, you can build an estate or something, then you can approach people to pull their funds together and for you to start maybe developing the piece of land and all of that. In some cases, right, it might not be that straightforward, but the most successful hedge funds in the world, like if you do your research, usually are very, very based on, their success is highly dependent on the deal that is at stake. So nowadays, people don't just invest blindly, so you have to find a great deal. This is a great way to raise capital, a great way to put money in something you've always wanted to. It must be remember, a hedge fund must go towards investments that are highly lucrative because it's high risk. And it's a great way to start, and it's a great way to get paid. You get 2% of the total capital, and you still get to keep 20% on returns of investment for simply managing those investments during the hedge fund lockdown period. I hope I'm able to shed more light on this. I will also be doing more videos demystifying certain investment terms, because many people think that they are beyond reach or they're just out of reach. They're not out of reach. They're things that you and I, with the zeal and the how will I put it, determination to make it, can have access to. Then again, thank you for joining me. Don't forget to subscribe. I see you. Yes, you're watching. Those of you who haven't subscribed, please hit the subscribe button for more videos like this. And do have a wonderful day. See you.